Welcome to our Wealtheon Growth Strategy webinar. My name is Victor Zwart, CEO of Wealtheon Asset Management. I will be presenting today with my colleague Daniel Patrick Sotelo, Portfolio Manager at our Geneva office and member of our investment committee. And we will look at the outlook for the second half of 2022 and the investor risks and opportunities. And during the webinar, as usual, you can ask your questions by using the question tool on the right side of your screen, and we will try to answer the question by the end of the webinar. And we aim using around 45 minutes of your valuable time today. So we're going to kick off with some macroeconomic developments to bring you up to speed. And overview that we like to show you is the GDP growth estimate for 2022 and 2023. And you see at world level, we are talking about 3.6%. You might remember that at the beginning of the year, this was around 4.5%. So it has been lowered to 3.6 due to all the developments in the world, the Ukraine war, the situation with the energy and Russia, etc., etc. So we are looking at lower levels. However, it's still 3.6% growth. Let's not forget this. All the news on the television channels and newspapers is very negative. And we all know that these news channels like to talk negative because bad news sells, and it's important to make up your own strategy and vision and to look at the numbers as they are. You see United States and Eurozone for this year around 3.7, 2.8%, next year heading towards 2.3%. Before COVID, we were looking at levels of 1.9 and 2.1%. For the US and the Eurozone. So 2.3% is still relatively attractive. Obviously, time will tell if these levels will be achieved. Now, a very favorable indicator is the unemployment, which currently shows a level in the Eurozone slightly below 7%, which is quite low, as you can see here on this 10-year chart at the red line. And you see the blue line around 3.7%. Which is also historically low. So unemployment is giving a very strong positive signal. People are working, employment is still being created. There are a lot of jobs that look for people, and this is exactly also immediately the same, or leading to a problem. And there are not enough persons to fill those job openings. So what happens? Employers are pushing up the secondary employment conditions and are increasing the offered wages. And of course, if wages go up, slowly it has an impact on inflation. This is what we see today. So on one side, it's very positive, these low levels. Obviously, on the other side, we have some inflationary impact as a result of this scarcity. If we look at the retail sales, that's what everyone is spending on a daily basis. We still see very strong numbers. In Europe, we are looking at around 4% growth year on year compared to the levels of last year. And in the US, it's around 8%. So these are very good numbers. Let's not forget this. Not everything is negative. And despite all the negativism in the world, people are still there. People still have a budget to spend, and as long as unemployment is not significantly increasing, there's no need that this should change unless confidence is going even lower than where it is today. If we look at the leading indicator, something that tells us about the near future, we see that the orders of goods are growing by approximately 10%. And 10% compared to the level of last year, which was also not bad. Last year, we were also looking at levels around 10%, even a bit higher, is still very good. The more orders we see, the more economic activity in the coming 3 to 6 months. So this is clearly a strong signal. Now, everybody's talking about inflation. Everybody's talking about economic growth and the equilibrium exercise and that central banks today have to perform to see how they can manage this quite exceptional situation where we are living in today. Now, of course, inflation all started, I think, basically with the rising oil price. You can see here on the right side of the chart a 20-year-long development of the oil price with an average around $70, and today it's not far away from 120. It has been a bit higher, it has come down, but it's very volatile still and definitely above the average of the last 10 years. So this is it's really a pity, obviously, because it's disturbing the economy as a whole. As you might know, that oil is used in many levels, on many levels of the economy, not only by the consumer filling up their cars at the gas station, but it's also, of course, a major commodity in industrial processes and transportation, etc., etc. So it is really everywhere visible in the economy. And it would have been nice if governments as a whole would have attacked the high oil price when they decided to cut off Russia and to reduce the purchase of Russian gas and Russian oil and focus on compensating this for their own countries, instead of now central banks being forced to try to slow down the total economy by increasing interest rates, which is hurting, obviously, far more people than could have been the case by artificially lowering the energy prices. But okay, this is where we are today, so we have to accept it. Now, inflation has been going up in the last 18 months. You see, especially this year, it's going very fast. We're looking here at the inflation in the Eurozone, and it's a breakdown. So it shows you what is happening inside the inflation. And a couple of components are quite visible. On top, the pink one, transportation. The green one, energy. Well, you can see that it has been enormously expanded to where it is today. And we see the blue one at the bottom, which are food and non-alcoholic beverages that are also showing some inflationary pressure, 1.5% up now as a element or component of the 8.10% for the Eurozone. In the USA, we have a total level of 8.6%, whereas energy is important. And at the bottom, you see the services in blue, ex-food and energy. And then in the orange, there are the goods, also ex-food and energy. So three components where energy, of course, is again a very important component in the total inflation. Now, as you see, the inflation is topping out a bit. For the last 3 months, it's more or less going sideways. And this is the big question. When will we see lower levels of the inflation? Everybody is looking at it. Everybody is counting on it. But so far, we haven't seen it. Now, we have put here in this inflation chart of the USA, we have included 3 red squares, which represent where each square represents a quarter. So June, September, December, and December, March of this year and early next year. So as you see, inflation was going up very, very rapidly in that period. And inflation is simply the comparison of a package of goods and services, the price level of those goods and services compared to the same price level a year ago. And what we see, of course, is this rapid increase means that we are going to compare with higher levels. So unless everything is still growing, prices are still growing by 8.5% or other strong levels, inflation will continue to go up. But we see indications of certain elements that we will discuss later where prices are coming down. So there is a good possibility that in the coming months, we might see more of a sidewards moving inflation or even a decline of the inflation, which is, of course, important. You see this is a core inflation, so no food and no energy included. As we saw before, that food and energy is still expanding on an inflationary, on a price level. But you see, if you exclude those components and you look at the core inflation, you see that now the inflation has been coming down for the last 2 months. Well, is this a trend that will continue? Nobody can say at this stage. It's too early, but in any case, it has to start somewhere. And from there on, it can only show us in the coming months if this is a consistent trend or not. Now, if we look at the forward expectations. How are economists in the world looking towards the inflation levels a couple of years ahead from now? This is a 5-year level. You see that we are talking about 2%, 2.16 in the Eurozone and 2.65 in the USA. So, of course, this is far away from now. We understand. And what is important to see is that these levels are still acceptable. And they might be wrong with 1%, but in any case, they are not predicting levels of 8% at this stage, which is important because then we would have a completely difficult environment, obviously. So this is, at this stage, still quite optimistic. Now, looking at risks and opportunities in the market, we always tend to look to the interest rate development. This is the 10-year interest rate on your left side, where the blue line is US 10-year interest rate and the red line represents the Eurozone. And you see that both lines have been coming up. The red one is exiting the negative territory. So 10-year bond giving you a negative return. You might remember we show this chart always during the webinars, and you see that we are now reaching levels somewhere between 1% and 2%, around 1.6 actually. And the US is already a bit above 3%, heading toward 3.4, 3.5%. Now, the right chart is showing you the difference between the two lines on the left side, and this is one of the elements that can play in favor of the strength of the dollar. Now, the levels of the interest rates on the left are not this high yet. Of course, it's a changing environment, we understand, but let's be realistic. If we look back in the history and in the last 30, 40 years, interest rate levels of 1.5% or 3.5% are still relatively low and acceptable and by corporations and consumers. Now, it is changing, we understand, and here you see the 10-year interest rate hitting 1.6%. It is very likely in Europe that this interest rate will continue to go up. We should not forget that in the US, the Federal Reserve Bank already started at the beginning of the year to announce a more restrictive monetary policy and no more bond buying to bring down interest rates, and announcing interest rate hikes, which we already had 25 basis points, 50 basis points, 75 basis points in the last meeting. And it's very likely that if interest rates are not coming down soon, that they will increase another 1 or 2 times with 50 or 75 basis points. At the same time, this offers the Federal Reserve Bank a tool, an important tool in the future, that should economic activity slow down, they can bring down the interest rates again, if the inflation level allows this. While at the same time in Europe, the European Central Bank has still to start raising interest rates. We are still close to zero, and there are no such tool as interest rate decreases at this stage available to the central bank to support the European Eurozone economy. Now, we think we are in a transition period. Because for a long period, almost 40 years, interest rates have been coming down. Now, you might remember those interest rate levels around 12%, inflation at 14%. And since then, it's been a long way, but on average, interest rates have been coming down. Now, this has obviously always supported the economic development. At the same time, since 2008, the financial crisis, central banks have been stepping in every time when it was necessary by means of liquidity creation or decrease of interest rates. And this is over. Central banks have clearly said that they are now in a restrictive, hawkish mode, and they will not step in to support the economy at this stage. Inflation needs to be brought down. So investors can no longer count on those two elements, which has been favorable. Now, what does it mean, those rising interest rates? Obviously, the cost of financing goes up. People who have a mortgage need to refinance. You want to buy a house, you have to pay a higher interest rate. Companies who are active in mergers and acquisitions usually try to finance it unless they have large cash reserves, and the cost of financing goes up. and also governments who have continuously to refinance their own government debt, of course, are also looking at higher interest rates. Now, what we saw, interestingly enough, a week ago was the European Central Bank, who stepped in to support Italy. Italy was confronted by a 10-year interest rate above 4%, and looking at the debt situation of Italy, the central bank decided, the European Central Bank decided to start buying Italian bonds to push down the interest rate. So what we see is more like a tailor-made, case-by-case approach that ECB is ready to set off or to start, instead of taking decisions for the whole Eurozone as a whole. Now, finally, we also need to get used as investors to lower economic growth levels and corporate results compared to last year. I think we should realize that 2021 was an exceptional economic year because we were getting out of COVID. 2020 was a very weak year, and everything looked fantastic in 2021. Now we are slowly getting back towards more reasonable levels, and unfortunately, thanks to the Ukraine war, the high inflation, and the decision by central banks to fight the inflation, which is understandable, we have completely changed as an environment, investor environment, and we need to get used to different levels of growth and results. Now, this chart might look familiar to you. This is the World Equity Index, and the blue line is the valuation of the market. So is this a expensive market? Are equities expensive or relatively cheap? The yellow line is showing you the index. And you might see that the blue line, was representing the price earnings ratio, so the valuation of the market, has been coming down last year to like a stairs almost towards the end of the year. And this year it's still going down further. Now, last year it went down because earnings were growing rapidly and it was pushing down the valuation. This year, obviously, earnings are quite stable, but markets have gone down, and so prices have gone down, which has pushed valuation even further down. Now, if you look at the left side of the graph, you see the green circle, which says 16.3, and above my head, you see the green flash, which shows you the 10-year average valuation of the market at 20. So we see that the current level, 16, is significantly lower than the average. So that means that this is attractive as an investment at this stage. Now, if we look at the same, we do the same exercise for the Standard & Poor's 500, and you see on the left side 18 in the green circle, and you see an average of 20. Let's not forget that the S&P 500 has a lot of technology companies in it, and technology companies tend to have a higher price earnings ratio. So including all those technology companies, which represents around 25% of the S&P index, it is lower than the 10-year average. And if we look to the European valuation, we see a current level of 14.7 compared to an average of 22. So the same goes for China, the same goes for the Nikkei, Japan. All those markets have come off. Earnings levels have been relatively stable, and the valuation has come down significantly. So one could say that the markets are actually quite attractive from a valuation point of view. Now, what could be a driver for the market to come? We can say that, first of all, we started with the global growth, economic growth of 3.5%. The world economy is still growing, and that's important. So there will always be new opportunities. We are going through a difficult phase now. It's in the phase of adaptation. It's a reset. It's a change of environment, but it is also know that the world will adapt to it, and new opportunities will arise. We will know, we will know hopefully quite soon, and it looks like it, that inflation is starting to top. and might even start to decrease. Is it this month? Is it during the summer, after the summer? Nobody can predict that exactly, but it is likely to happen if we look back to the trend last year and the year-on-year comparison. What we also have is a clear communication by central banks on monetary policy. Central banks tend to be quite clear on what they are doing, and if they see that inflation is coming down, then they might communicate that maybe future interest rate hikes might take more time and might be less aggressive. And this, of course, extremely important to the market because everybody is so focused on interest rates that this could give a very nice signal, a relief signal to the market. Now, the gradual acceptation of lower corporate results we already discussed, and we should not forget that you cannot wait until all traffic lights are giving a green, showing a green light, because the market always anticipates future developments. So if you want to wait until all the news channels are positive again and show you how great the investment year has been, then the market has already recovered rapidly or gradually. That's to be seen, but the market always anticipates, that's for sure. Now, we're moving towards our approach, and I'll give the floor to my colleague Daniel for this.
Thank you, Victor, and welcome to everyone that has joined our growth webinar today. As mentioned, I will be running through the portfolio positioning, looking at how assessing macroeconomic indicators translates to current portfolio investment strategy, talking a bit about the fixed income, what's happened in the fixed income markets, going through the equity side, looking at the region, the sector, and giving you a bit of indication of what regions we're confident with. So let me start with the fixed income side, because there's been a lot of movement in the fixed income markets since the start of the year. We've actually seen one of the worst, it's not been as bad as this year ever, because of the drop in corporate bonds, in high yields, in American market bonds. There's been some drops of up to 20%, which is considered as bear market territory. So here on the slide, you will see the cumulative performance of our bond portfolio and the linked benchmark. And as you can see, the linked benchmark is at around -13%. And this, we're really talking about bonds and bond portfolio, and they're meant to be the most sort of stable and less risky investment. But because of the low to negative interest rates for so long, and now the highest inflation rate in such a long time, and the interest rates moving up, is completely changing the environment, and it's not making the bond market it's not doing the bond market any favors. It's becoming an unfavorable asset class, and we can see that through the negative performance year to date of the bond portfolio. But having said that, a number of the decisions that the investment committee made has led to an outperformance and compared to our benchmark, and this is really for a number of reasons. First reason is that we decided to have a much shorter duration than the benchmark. We kept a short duration of a few years, 3 or 4 years, and this is because this is to reduce the impact of the interest rate risk, the impact of the increase in interest rates. So by keeping a shorter duration, we reduced that risk. And then the inclusion or the increase in exposure in inflation-linked bonds and floating rate notes that typically move in sync with interest rate variable rates, that has led to for our outperformance compared to the benchmark. So pretty good news on the transactions that we've done on the bond side. At the bottom, you can see the periodic performance, and even from the start of the year, the bond markets has negatively performed. You can see from May up until June, the benchmark dropping much more than our bond portfolio. And this is because of the changes and the adaptations we did since the start of the year. This is a very interesting slide. So when you hear about things being priced in the markets, this slide shows the expectations of the markets on the dates on the left. So you can see that the market has already priced in an implied rate of 2.275% in July, and over time until the beginning of 2023, slowly but surely increasing or seeing those hikes from central banks or from the Feds up until 3.8% the beginning of 2023. And we've had the biggest rise in interest rates in the long end. So really a lot of it's already, and this is again a reason why there's been a lot of movement in the fixed income markets, because a lot of it's already being priced in anticipation of future Fed hikes. So you see a similar picture over in the Eurozone. Again, it's the same slides. They can move their interest rates by 0.1%. So it's not the 0.25% that you see in the US, but already we're really going from experiencing negative territory interest rates in the region to positive territory. And the ECB, the European Central Bank, they must do something. They need to start in July because of the higher inflation rates. So we see the implied rate of around 2% in the beginning of around May 2023. And if this is true, we've had the worst in the long-term interest rates, and this is what the market expects. And then really going back to what Victor was saying earlier, we really see these levels are, compared to historical levels, still very low. Interest rates between 2 to 4% seem to be the norm, and investors will adapt to the change. We've got used to a decade of incredibly low interest rates to stimulate the economy, to see economic growth, and now things are changing because of the current market environment is changing, and we adapt as we move forward. So this another very interesting slide on the fixed income side. This graph shows you the spreads above the German interest rates. So as you can see, in 2022, there's been a sharp incline in spreads, moving very fast. And now we are seeing the interest rates on high yield of around 5.7%, which when we look back to pre-pandemic and the impacts the pandemic had on the fixed income market, specifically high yield, we're seeing very high levels. And what this means, it creates some opportunities within the high yield space. So what we've done is we've increased our exposure to the high yield ETF within the bond portfolio, capture the interest rates of 5.7%. And we believe if spreads increase further, we add. But we believe that within the 12 months period, we can make a positive return through this investment. So again, very much a number of opportunities popping up in the high yield markets. So for those that have tuned into our webinars previously, you recognize the setup of this slide, just showing you the decisions that we've made over the course of since the beginning of 2020. As you are well aware of, and throughout 2021, we were pretty much fully invested. And then at the beginning of 2022, a lot of uncertainty within the markets, a lot of talk about inflation no longer being transitory, and then the impacts, and then the whole start of the war in Ukraine and the impact on the energy on energy sector. So we decisively reduced risk by selling equities in three blocks from the beginning of April up until the beginning of May. And we've been doing that, exiting a number of positions that we had profited on over the course of the past couple of years. And again, making sure that we created enough liquidities within the portfolio to then really benefit from the decline in stock markets. So the investment committee will be assessing new stocks, either within existing stocks within the portfolio or new additions. And that's something that once they feel comfortable with, once we have a better idea of where the economy is going to go, we will then deploy that cash that we have within the portfolio. And when I'm talking about a fully invested dynamic profile, we had between 20 to 25% cash. So very much happy. And we have started to deploy some of that cash to a couple of names, a couple of stocks that had been trading at lower valuations, but the fundamentals had remained the same. So again, we'll use that same strategy when deploying the rest of the cash in the portfolio. Quick one on the region allocation, nothing really new here. We still have a higher allocation towards the US, just under 60%, and Europe, because we're more confident with these developed markets. And again, something to note is the emerging market exposure, because of the higher dollar and the higher interest rates. I mean, these regions are a lot more vulnerable. So we have little to no exposure in Asia Pacific and emerging markets, and up until now we're confident with the region allocation. Quick one on the sector. I'll go from left to right. The IT, as you will know, we've had an over exposure in the IT for quite some time now, and over the past 12 months we've been reducing that overweight exposure to the IT, as we saw that interest rates were likely to be going up to control inflation. This typically hurts the higher PE stocks within the sector, and we've experienced a bit of multiple contraction. I'm sure you're all aware of the Nasdaq is down somewhat in the 20s, 30s since the start of the year. But again, we're very much confident with the stock selection that we have within the IT sector to have that overweight exposure to IT. And again, really what we've been doing is increasing our exposure to the consumer staples, materials, and healthcare. Again, very much looking to make the portfolio a lot more defensive and reducing that beta of the portfolio. And again, to add, we've been reducing our exposure to consumer discretionary communication services. So as you can see, we have a much lower weighting than the benchmark. So again, just to reiterate, consumer staples, materials, and IT overweight, and consumer discretionary communication services underweight, little to no exposure, again, in utilities or real estate. So again, we then look back and assess our decisions, and we look now at a relatively short period. We look at the change in allocation since the start of the year, and then look at where the sector, how the sector has performed year to date. So let me start with the bottom three sectors: communication services, IT, consumer discretionary. We decreased our overexposure in these sectors by the amounts mentioned on the slides. Typically from around 4 to 5% of reduction, and those are the sectors that have been hit quite hard since the start of the year. You can see that those sectors are now down in the 30s, so that's helped us avoid having the full effects of the severe drop in these sectors. What we did with those proceeds is we increased consumer staples, increased the energy sector, and consumer staples on a relative basis has done well. Again, it's more defensively orientated, and we picked up a number of good quality companies within the sector. And then energy, I mean, energy has gone through the roof, whether that's in terms of sector performance or energy bills. We added 4% allocation towards energy, and the sector is up just shy of 30%. So really confirming that the sector rotation, but also the stocks within the sector is somewhat providing us positive impacts on our overall performance. Just for me to finish off on my section, again, just to reiterate, we have a preference for the US, very resilient economy. Doesn't really have much to do, or has low exposure to Russian markets, Ukrainian markets. So they're not really dependent on any energy imports. Again, because of the interest rates, but because of the strength of the economy, they see that the value of the dollar has appreciated. So this is all supports the US economy. We understand that Europe has more links and more ties. There's a lot, I mean, the energy dependence of the Eurozone to Russia is somewhat worrying. This is creating a bit of a negative effect on the investment climate and also the value of the currency. But we very much monitor this. And but if we're looking at the indicators on the bigger picture, we believe that these two developed markets, the US and Europe, have what it takes and will capture a lot of the global economic growth that has been forecasted. China, if we look at pure valuations, is getting more attractive as in investments, but as we've learned, or as we've seen, as we've experienced, we need to have a clear view on the Chinese government policy. Whether we get that, we don't know. But until we have a clear indication on the macroeconomic side of things, but also the reinforcement from the political party in charge, then we will start to slowly increase our exposure to Asia, and more specifically China. And on that note, I will pass this over to Victor, and he will finish off with the outlook and the conclusion. Thank you very much for listening, and I hope to see you all soon.
Thank you, Daniel. Thank you very much indeed. We're looking at the outlook, and I'm going to show you a chart, which is the MSCI World Equity Index. So this is a 22-year chart of the World Equity Index, all stock markets together, just to put in perspective where we are. So you see some larger corrections with the financial crisis in 2008, and even before there was the internet bubble, as we know that period. And then you see later on at the end of the chart the COVID period and where we are at this stage. So just to put the development into perspective for you. Now, if we look at the elements of market disturbance, we have inflation, and we already discussed it. We have discussed the interest rates and the fact that they are going up. We have not yet discussed China with the zero COVID policy, which lockdowns that have been imposed on cities like Shanghai with 25 million citizens is slowing down Chinese economic growth, obviously. We have the supply chain issue, which is still the case. First of all, because of COVID and all the backlog on trying to solve it when the world was reopening again. Everybody announced already that it would take 1.5 to 2 years. And now we had the Chinese policy of lockdowns and the harbors closed again, which is postponing this recovery of the supply chains. Now the harbors are open again. Let's hope that they stay open, but it might take another 1.5 years before the problems are completely solved. Ukraine, humanitarian crisis, still ongoing, creating uncertainty, scarcity of certain products, and like pesticides or like grains, the food components. We have had, of course, downward revisions of the growth levels of economies and the danger of recession that is approaching, which is creating nervousness amongst investors. Some people even talk about stagflation, which means a high inflation and no growth at all. We don't think that this is yet something that needs to be anticipated, but okay, time will tell. Recession could be possible. A recession, what is a recession? A recession is a negative economic growth during 2 consecutive quarters. So it can also be 0.5% negative or 0.1% during 2 quarters, and then you call it a recession as well. Let's not forget that we compare with a very, very strong year, 2021, and it's not very strange that levels this year are lower than last year. So this was already anticipated in the estimates, and because of the whole Ukraine and Russia and all side effects and central bank policy, these levels have been pushed down even further low. Then we have also corporate results. The first quarter results are out. The second quarter results are now coming out. Actually, not bad at all. Let's not forget that many companies have produced very reasonable and even attractive earnings results. The thing is that the moment a corporate management announces that they are prudent, they have a prudent view on the next 1 to 3 quarters, it is considered as negative, and stock prices are punished and going down 10 or 20%. One way maybe because some investors lose confidence. Other way, there's a lot of automatic trading also going on based on algorithms that are simply scanning the news, and if they see negative news, they sell. They see positive news, they buy. And this also explains the huge volatility of certain stocks and the huge daily percentages. Sometimes you see a stock going down 7% on a day, which of course in the market capitalization point of view is a huge amount. One could demand itself, is that reasonable? Now, if we look at the same level, same elements and the evolution, potentially we see lower levels, as we discussed for the inflation, might emerge soon in the next 1 or 2 quarters. Interest rates heavily depend on the inflation trend. We know already that USA has started raising interest rates, so they might also end this restrictive policy sooner than the counterpart in the European Union. The European Central Bank still has to start raising interest rates. So it's a different environment and a different perception for the global investor. China should open up completely. Zero COVID policy is still on the radar, and the President Xi is waiting for the re-election in November, when the Chinese Communist Party is gathering again and should re-elect him. And we think that he might stick to his zero COVID policy until this re-election, simply to show that he is right and others not. And he cannot now stop this policy. So that's of course a problem for China temporarily. Supply chain, we already discussed it. First sign of improvement are there. We hear that transportation prices are coming down. We see that building material seems to be starting up again after the huge demand what we have seen in the building sector. It is now slowing down a bit in the world, and this is of course helping to partially recover the supply chain for this sector. Now, Ukraine remains impossible to predict. I think this will remain an element of uncertainty, especially for Europe, who's more exposed to it than the US. And of course, we all hope that there is soon a solution, but we cannot do any prediction on that crisis, unfortunately. And then we have the growth levels in the world. Let's not forget that as long as the economy grows between 3 and 4%, we still talk about a decent growth. We're not talking about a global recession. Now, looking as a summary to where we stand today, then we know that the Western stock markets went down between 20 and 30%. this is something we should take into consideration. I mean, the markets have gone down already, and of course they can go down further. There's no one who can prevent that, obviously, but this is already quite some correction. It's not nothing. So let's say the downside risk is less than half a year ago, but still present. But at the same time, we see that everybody is negative, both investors and experts. And this, in the past, has often been a sign that the bottom of the market could be reached. And there's no guarantee for that. But if everybody is negative, then maybe you should looking at maybe buy a little bit left and right, and gradually you make use of some buying opportunities. Now, we know that the market valuations are below their 10-year averages. This goes for many developed and frontier stock markets. So that makes equities attractive, especially compared to bonds. And bonds are exposed to rising interest rates. The yields on bonds are very low. And if you correct the yield on the bonds for inflation, even if the inflation should come down from 8 to 4%, you still will have negative returns. So bonds are still not a very attractive alternative for equities. We have a strong conviction regards the quality of our companies. We think that the selection we have are healthy, good positioned companies, and that will draw the attention of investors once confidence returns and money moves back into the market. We think that our companies will again be amongst the winners. We also think that the major trends will continue. We're going through a difficult phase now, but it does not mean that the big trends, developments, R&D, new techniques in healthcare, e-commerce, online payments and chips, etc., have stopped. Billions are being invested in those segments as we speak, and we think that those trends need to stay into the portfolio. Once confidence returns, people will be drawn back to those trends as they are amongst the most promising developments in the world. We have some companies in our selection that went down. Well, we have a lot who went down actually, but we have some who went down above average, and we think that we should put in some cash to buy those companies additionally at those levels and the low levels that we see today. We will not do it all at once, but we will gradually take profit of the low levels in the market. And finally, we think that the market volatility will be present until 2003, or maybe even the first quarter of 2003. And why? Because simply, as I said before, we are comparing current results, current economic growth numbers, current earnings with 2021, which once again was an exceptionally strong year. And this will slowly move to the comparison, will move towards 2023. The first quarter of this year was not bad, indeed, so there might still be some disappointment, but at a certain point, investors will get used to the new levels, and we will get out of this negative period, and then we might see some expansion again, and we might see some upwards revisions of growth levels or of earnings levels, and then of course confidence will return, and once again the market will most likely react way before this happens, because that's how the market psychology works. Now, to end with the last graph, we see the investment of the S&P 500 trend. And this is a 50-year chart of the S&P 500 index. And I show you this because investing in the stock market is not a day-to-day activity. It's a long-term commitment. You should see your investments as an investment into a company. If you are the owner of a company, you also follow the results on a monthly or on a quarterly basis. And if you are disappointed, you look at the quality of your company, you look at the quality of your management, the positioning of your products, your pricing power and other elements that might be important to you. And then you adjust or you stick with your company. The same goes here. You see that the market has sometimes difficult periods, but over time, the market goes up. And that's why investing is a long-term commitment. Now we're moving towards a question, and with an eye on the time, I will take a question that was sent to me here just now. The question is, does it make sense to sell my portfolio now and to hold cash? Well, I think a basic rule is if you're no longer sleeping well because of all the turbulence and all the volatility, and if you don't care at all on missing out on a market recovery, then cash obviously is an alternative, because peace of mind is of course important. Most investors obviously don't want to miss out on a market recovery. Secondly, you should also not forget that once you're in cash, you're completely exposed to inflation, and your purchasing power, as we speak today, is going down by 8% per year. You're missing out on dividends as well, so you have no return on your cash. So yeah, with the inflation on top of it, you're losing purchasing power every year. And even if it goes down, the inflation goes down to 4%, you're still losing 4% on purchasing power. But I think that's maybe a side effect of a decision to go cash. I think the most important element is that you're selling out of the market, knowing that the market went down already between 20 and 30%. Knowing that a lot of people are negative now, so you're also amongst them who is reacting. Probably, yeah, it's a risky decision, obviously, because yeah, the market can recover next week, in a month's time, in 2 months' time, in 3 months' time, and nobody knows exactly. But at a certain point, the market will recover. And it might still go down a little bit, as I said before, or maybe even 10 or 20%, but at a certain point in time, it will start recovering. And it's very, very difficult to time that moment, because we have so many different elements in play at this stage, and some are heavily linked with each other, as I explained to you before, and the market might suddenly start reacting on a change of the environment. So I think I would not do it. I think if you're convinced of the quality and the condition of the companies that we have in the portfolio, that they also are good products for the future, and they continue to be an attractive investment, especially at the levels where we are today. So my final remark would be: don't jump off the bus at this stage. The bus is driving on, and it will reach better times. I thank you all for your participation to our webinar. Also on behalf of Daniel and our Wealtheon team, we remain at your disposal for any further questions that you might have, or to organize a meeting. Please do know that you can follow us on Instagram and LinkedIn if you would like to stay in touch. And we look very much forward to seeing you again at a next occasion. Thank you very much once again, and this is the end of our webinar.